What causes BTC to pump and dump? This is a question that's been on everyone's mind lately, and the European Central Bank recently published a report that provides a very compelling answer. It found that BTC's price is determined by the people who are buying and selling it, specifically if they see it as a safe haven or a risk asset. If you can understand this, then you can predict BTC's pumps and dumps. That's why today we're going to summarize ECB report and tell you what it could mean for the crypto market. This is a video that you do not want to miss. The report we'll be summarizing today is titled Global and Local Drivers of Bitcoin Trading via Fiat Currencies. It was published by the European Central Bank, or the ECB, earlier this month, and we'll leave a link to the full report in the description if you're interested. Now, the report begins with a brief introduction wherein the authors ask the same question we've asked at the beginning of this video, but in a much more long-winded way. And I quote, "To what extent is Bitcoin usage a global phenomenon driven by speculative demand? To what extent can country-specific factors explain the use of Bitcoin? What drives the adoption of an unbacked digital currency like Bitcoin?" Well, to answer these questions, the authors looked at BTC traded volume against fiat currencies in different countries. Now, what's really interesting here is that they analysed these traded volumes on a peer-to-peer, aka a P2P crypto exchanges, many of which, ironically, have gone bankrupt because of EU's crypto regulations. The authors explain that they chose to analyse traded volume on P2P exchanges because they're used primarily by retail investors and therefore are not prone to market manipulation, as seen on regular exchanges. If you want to know how bad this market manipulation is, you can check the link in the description. Anyway, the authors then go on to explain that they analysed traded volumes against 44 fiat currencies on local Bitcoins and Paxful between January 2018 and April 2022. Notably, the authors excluded the US dollar from their analysis due to, and I quote, special status. They didn't explain what that meant. In any case, with this data in hand, the authors assessed three things: the effect of crypto-specific factors on BTC's price, the effect of macro factors on BTC's price, and the effect of country-specific factors on BTC's price. Notably, the authors acknowledged that crypto has its own bona fide 4-year cycle. The authors pay particularly close attention to BTC's trading in so-called emerging and developing economies, presumably because this is where Bitcoin adoption is the highest. They note several factors contributing to this adoption, including exchange rate volatility. They also speculate that the absence of developed financial infrastructure could also be a driver of BTC adoption in emerging and developing economies. If you watched our video about what's happening in Nigeria, however, you'll know this doesn't seem to be the case. There are deeper drivers at play, namely trust in institutions. Regardless, the authors reveal their results, and I quote, "point to financial stability risks associated with BTC. They argue these risks should not be ignored because crypto links with traditional finance systems have been increasing." Not surprisingly, the authors put stablecoins in the crosshairs here. This is not surprising, given that the ECB is scared that a stablecoin could challenge or even replace the euro. Lo and behold, the authors allude to this a little later, and I quote, "These developments raise the risk of cryptoization, the substitution of domestic currency with a cryptocurrency. Be very afraid." In all seriousness, the authors admit that they're surprised at just how much BTC has grown despite being, and I quote, "an unbacked crypto asset." The authors then describe BTC's global popularity in a way that makes it sound like the next pandemic, and note that it's been really difficult to measure its effect at the country level. They proclaim that this report fills the gap in existing central bank literature about BTC's country-level effects by using actual data from P2P exchanges, not surveys. The result is that they're able to get a much better sense of when local factors are driving BTC's price in various countries. If you're enjoying the video so far, be sure to smash the like button and give it a boost. Now, the second part of this report is all about those P2P exchanges. You'll recall the authors analysed two, local bitcoins and Paxful, both of which were shut down earlier this year. Now, what's fascinating is that the authors classify these exchanges as, and I quote, off-chain decentralized exchanges. This is fascinating because the authors admit that, and I quote, P2P exchanges only match buyers and sellers, but do not act as intermediaries. Logically, this implies that it was inappropriate to subject P2P exchanges to the same regulations as CEXs, something which caused local bitcoins to go broke. Anywho, the authors explain that P2P exchanges have been really popular in emerging economies. They believe this is mainly due to the absence of liquidity on CEXs for smaller fiat currency pairs, which makes sense. Even so, they note that the US dollar is still the most used fiat currency on P2P exchanges. When you exclude the US dollar, the most popular currencies on P2P exchanges are apparently the Nigerian naira, the Russian ruble, and the Chinese yuan, and the Indian rupee. So if we understand correctly, one of the reasons why the authors omit the USD is because it makes it hard to know where the users are based. To put things into perspective, about a dozen non-US countries use the US dollar as their national currency, and many others peg their currencies to the US dollar. With limited data about the location of P2P exchange users, it's hard to know for sure whether those trading USD are based in the US or elsewhere. That said, the authors were able to get some location data from Paxful, and what they found was pretty crazy. Basically, those trading BTC for the Chinese yuan were not based in China. They were based in the US. There also appears to have been some geographically inconsistent activity involving the Polish zloty. Make of that what you will. Now, this all ties into the third part of this report, which is all about the data. To refresh your memory, the authors analysed BTC's traded volume against 44 fiat currencies and excluded the US dollar in their analysis. 14 of these currencies were from advanced economies, and the rest were from emerging economies. Once again, the authors explain that the US dollar was excluded because of its unspecified special status. This makes us wonder whether the authors found something in the US dollar data that they'd rather not tell us about. Otherwise, they would give us an actual explanation for why this US dollar data was omitted. Speculation aside, the authors found that BTC's trading against the British pound was the most active pair for P2P exchange users from advanced economies. What's wild is that 60% of BTC to Great British Pound trading on P2P exchanges was nonetheless being done by users in emerging economies, where the Kenyan shilling reigned supreme. Using a bunch of complex calculations that are outside the scope of this video, the authors assess the impact of macro factors such as tech stocks, crypto-specific factors such as the 4-year cycle, and local factors such as inflation on BTC's price. They also assessed each country's institutional features, including things like remittance costs, political risks, demographics, and so on.
We interrupt this programme for an emergency crypto weather forecast. Get ready for a whirlwind of savings. We're seeing some high-pressure sign-up bonus systems forming in the northeast, with some exchanges offering up to $40,000. In the south, we'll be seeing some heavy discounts on hardware wallets, so watch out for those if you're going to be out and about. And then in central areas, there's a high chance of trading fee discounts, which should be settling in later on, so be on the lookout for up to 60% off there. Lush! For a more comprehensive forecast, just visit coinbureau.com/deals or use the link down in the description. These deals are red hot, so make sure to take all the necessary precautions. Well, that's all for today's forecast. Now back to the scheduled programme.
This relates to the fourth part of this report, which is analysis on said data. As expected, momentum in the crypto market, a crypto-specific factor, as well as levels of global liquidity, aka money supply, a macro factor, and USD exchanges rates, a local factor, all play a role in BTC's price action. However, it appears the largest factor is speculation, which the authors estimate accounts for as much as 40% of BTC's volatility. As such, the authors state that BTC is still primarily a risk asset, even though it's being used in many emerging economies as a store of value and even as a means of payment. The authors then pivot to analysing factors that determine BTC's traded volume. Again, they found speculation brought on by crypto market momentum is the primary driver, with exchange rate volatility playing a secondary role. Now, oddly enough, macro factors have little effect on BTC traded volume. What's even more odd is that the relationship between BTC traded volume and market liquidity seems to be upside down. The authors found that BTC's traded volume actually tends to increase when liquidity is falling, at least in the foreign exchange markets. Another particular finding is that geopolitical risks have zero effect on BTC's traded volume, and that there's zero correlation between BTC's traded volume and gold price. This seems to be a sleight of hand on the part of the authors. As I noted, traded volume doesn't tell you anything about BTC's price. Very sneaky. Now, to be fair, the authors go on to cite another study which specifies that BTC's price has zero correlation to gold price. The problem is that this study is from 2021. Believe it or not, but BTC's correlation to gold has actually been increasing over the last few months, presumably due to the digital gold narrative. You can thank BlackRock for that one. More about the spot Bitcoin ETF applications in the description. Anyhow, another bizarre discovery is that the authors found no correlation between BTC traded volumes and inflation. This might have something to do with the fact that the authors compared BTC's traded volume to Google search trends. Alternatively, it could have to do with the authors' definitions. That's because the authors reiterate that there is a strong correlation between BTC's traded volume and exchange rate volatility. What they fail to mention is that this exchange rate volatility, that is, the decline in price of a currency against the US dollar, is often driven by the inflation of said currency. Naturally, the impacts of these factors on BTC change depending on if we're talking about advanced economies or emerging economies. For example, liquidity in forex markets mainly affects BTC's traded volume among users in advanced economies, whereas exchange rate volatility mainly affects BTC's traded volume in emerging economies. More importantly, the pandemic seems to have permanently amplified the effects of these factors. The authors take this as a sign that Bitcoin is being adopted, not just invested in. In other words, BTC is increasingly being used as an actual currency, not something that people are just buying to get rich. The authors note that the reason for Bitcoin adoption is outside the scope of their report. This is expected, given the reasons for Bitcoin adoption is probably something that the authors aren't even allowed to talk about: the decline in trust in institutions like central banks during the pandemic. More about that in the description. Now, after more complex calculations that are outside the scope of this video, the authors unpack the effects of those institutional features on BTC in emerging economies. They start by explaining that many of these factors, like political instability, are difficult to quantify, so they must make a few assumptions. Based on these assumptions, the authors found that BTC volumes are higher in countries with less developed payment systems, suggesting that BTC is being used as a substitute. As we mentioned earlier, however, this may not always be the case. There could be other institutional features at play. Case in point, the authors reveal that they use the number of ATMs available as a proxy for how advanced the payment system is in emerging economies. This is a questionable metric to use, given that ATM availability isn't always indicative of how advanced a country's payment system is. Look no further than cashless societies for evidence of that one. More about those in the description. Now, moving on, there is one significant institutional feature that the authors found, and that's age. The younger a country's population is, the more likely it is to dabble in BTC. This makes sense given that younger people are typically more in tune with technology. No offense to the boomers out there. Now, regarding the robustness of these findings, the authors reveal that some of the currencies they analyze were in fact pegged to the US dollar. However, they reanalyzed the data and found that omitting these currencies had no impact on the results, which again begs the question of why the US dollar was omitted. When it comes to the Chinese yuan or the Polish zloty, the authors found that omitting these currencies, likewise, had no effect on the results. You'll remember that both were heavily traded outside of their countries of origin, which certainly begs the question of what was going on there. The bigger question, however, is how the authors managed to find that things like dollarization, inflation, and capital controls had no effect on BTC trading. This runs contrary to the reality that countries that are adopting BTC the most are the ones where there's dollarization, inflation, and capital controls. Inconsistencies aside, the authors conclude by repeating that BTC's primary driver is speculation, and that this speculation is, and I quote, a truly global phenomenon. They again concede that crypto cycles exist, that BTC is affected by global and local factors, and that actual Bitcoin adoption is increasing. Incredibly, the authors admit that, and I quote, this indeed suggests that Bitcoin, despite its wide price fluctuations, might have been appreciated also as a store of value or a medium of exchange in countries which experience a loss in the purchasing power of their domestic currency. In turn, this implies that macroeconomic instability may potentially spur greater crypto asset usage. In sum, BTC is a safe haven. Of course, the authors can't help but throw shade at stablecoins in the last few sentences, underscoring the fact that they could see widespread adoption and result in the aforementioned cryptoization. What's funny is that the authors don't realize that this is already happening right before their very eyes. This brings us to the big question, and that's what all of this means for the crypto market. From our perspective, it means three things. The first is that BTC trading is likely to increase. That's because the main factor driving BTC trading volume are likely to increase in the future. These include the levels of speculation, which will increase as institutions get involved, the lack of liquidity in the forex markets, which will decrease due to the issues related to debt and interest rates, and the volatility of exchange rates, which will increase due to interventions by central banks. Again, an increase in BTC traded volume doesn't tell you which way prices will go, but it's safe to assume that issues in the traditional financial system will incentivize the average person to look for alternatives. Don't forget the quote a few months ago about macroeconomic instability and BTC adoption. This pertains to a second thing this report means for the crypto market, and that's genuine Bitcoin adoption is increasing due to its emerging role as a safe haven. This is evidenced in the fact that the amount of BTC on exchanges has been on a decline since the beginning of the last bull market. For those who don't know, lower amounts of BTC on exchanges suggest that BTC holders are hodling, not selling. This is a trend that's likely to continue indefinitely. This will make BTC's price more volatile, which will increase speculation, further attracting investors and users to Bitcoin. The third thing that this report means for the crypto market follows from the second, and that is that BTC is slowly, but surely, transitioning from being recognized as a risk asset to a store of value. To be clear, BTC is still a risk asset, and that means it will continue to experience incredible price volatility. As time goes on, however, BTC's price volatility will continue to decline, as it has been since its inception. For reference, research from Cointelegraph suggests that BTC's volatility will be on par with the volatility of the US dollar by the end of the decade. Put differently, BTC will be just as stable as the US dollar. If these projections are correct, then it could paradoxically create a problem for Bitcoin. That's because central banks like the ECB would likely start to take BTC more seriously. They could start to see it just as a threat like stablecoins and push politicians and regulators to try and restrict its adoption. Conversely, we could see central banks start adding BTC to their balance sheets, with some even trying to back their currencies with this digital gold. In case you missed the news, central banks will be allowed to hold BTC on their balance sheet starting from 2025. Chances are that some of them will do just that. And you can find out what this means for BTC's price using the link in the description. Well, that's all for today's video. If you learned something new, let us know by smashing that like button. If you want to keep learning, then subscribe to the channel and ping that notification bell so you don't miss the next one. If you want to help others learn, take a second to share this video with them. If you are accumulating crypto in preparation for the inevitable cryptoization, then check out the Coin Bureau deals page. It's got trading fee discounts of up to 60% and bonuses of up to $40,000 on some of the best crypto exchanges and the biggest discounts on the best hardware wallets. The link will be down in the description. Well, thank you all so much for watching, and I'll see you in the next one. This is Jessica signing off.